Progress, and I believe this is. This week's paper is Mispricing Factors by Robert Stambaugh and Yu Yuan, published in the Review of Financial Studies in 2017. Progress, and I believe this is. The thesis is that 11 well-documented return anomalies can be compressed into two composite factors, one tied to management quality signals. Progress, and I believe this is. One tied to recent performance signals, and that these factors explain the cross-section of stock returns better than the older workhorse models. Progress, and I believe this is. Here's why it matters. If anomalies are compensation for risk, a better risk model should explain them away. Progress, and I believe this is. Stambaugh and Yu Yuan argue that their factors absorb the anomalies not because they've found new risk factors, progress, and I believe this is, but because they've built a mispricing index. Progress, and I believe this is. And the short sale constraints angle is where this paper earns its money. And I believe this is. Let's see if the evidence holds. I believe this is. By the time Stambaugh and Yu Yuan were writing, Progress, and I believe this is, the academic literature in asset pricing had accumulated a genuinely uncomfortable number of anomalies, return patterns that Progress, and I believe this is, taken individually should not exist if markets price risk correctly. And I believe this is some of the best documented gross profitability, net stock issuance, accruals, asset growth, financial distress scores, momentum, progress, and I believe this is. Each of these individually had been shown to predict returns in the cross-section. Progress, and I believe this is. The author's starting question is whether these anomalies are 11 separate stories or whether they share a common factor structure. If they share a common factor, progress, and I believe this is, that points to a shared economic mechanism rather than 11 independent effects that happen to survive publication. Progress, and I believe this is. The paper they're implicitly building on is the arbitrage asymmetry literature, the idea that buying an underpriced stock is cheap, and I believe this is, but shorting an overpriced one is expensive. Progress, and I believe this is. Their question becomes, can you measure that systematic asymmetry in the form of a factor? Progress, and I believe this is. Stambaugh and Yu Yuan work with 11 anomalies drawn entirely from the prior published literature. Progress, and I believe this is. They don't construct novel signals. They're using documented, replicated, well-known predictors. And I believe this is. The 11 include net stock issuance, composite equity issuance, accruals, net operating assets, asset growth, progress, and I believe this is. To assets, the O-score distress measure, momentum, return on assets, gross profitability, progresses, and a measure related to return variability. The sample is a broad U.S. equity universe covering several decades of CRSP and Compustat data across NYSE AMX, Progress, and I believe this is, and NASDAQ, with the standard exclusions for very small stocks that dominate anomaly returns in small cap space. Progress, and I believe this is. Each month, every stock gets a percentile rank on each of the 11 anomalies, from most overpriced to most underpriced. Progress, and I believe this is. The key methodological move is that they don't run these anomalies individually. Progress, and I believe this is. They aggregate them into a composite mispricing score. Progress, and I believe this is. That aggregation is where the factor construction begins. Progress, and I believe this is. Here is where the paper gets methodologically interesting. Progress, and I believe this is. Rather than treating all 11 anomalies as interchangeable, the authors find that they cluster naturally into two groups. I believe this is one cluster. They label it MGMT, contains signals related to how management deploys capital issuance activity. Progress, and I believe this is. Investment growth, accruals, net operating assets, and related items. Progress, and I believe this is. The interpretation is that MGMT captures managerial decisions that tend to destroy shareholder value relative to investor expectations. Progress, and I believe this is. The other cluster, PERF, contains signals more tied to recent operating performance and momentum. From each cluster, Progress, and I believe this is, they compute a composite mispricing score per stock by averaging percentile ranks across the signals in that cluster. Then, exactly like Fama-French construct HML or SMB, they form factor portfolios. Progress, and I believe this is. Long stocks scoring in the low mispricing decile, short stocks in the high mispricing decile. Progress, and I believe this is these long-short portfolios are MGMT and PERF. The construction is transparent and, importantly, progress, and I believe this is replicable. A genuine strength of the paper compared to more opaque factor engineering. Progress, and I believe this is when Stambaugh and Yu Yuan run the horse race, their two mispricing factors against the Fama-French 3-factor and 4-factor models. The results favor their model. The GRS test, progress, and I believe this is, which is a joint test of whether a factor model leaves significant unexplained alpha across a battery of test portfolios. Progress, and I believe this is, favors the Stambaugh-Yu Yuan model over the 3-factor benchmark. I believe this is more concretely, when MGMT and PERF are included as controls in time series regressions. Progress, and I believe this is, the alphas on the individual anomaly portfolio shrink substantially, and many become statistically insignificant. Progress, and I believe this is, the interpretation the 11 anomalies were largely loading on the same two underlying factors. Now that finding cuts both ways. Progress, and I believe this is, it either means you found two priced risk factors, compensation for something systematic that hurts investors in bad times, or it means you've constructed two efficient mispricing indices that aggregate systematic investor error. Progress, and I believe this is, the paper's argument is the latter, and that's where the short sale constraint section comes in. Progress, and I believe this is the part of the paper that connects to a mechanism rather than just a pattern. Progress, and I believe this is. The key concept is what Stambaugh had developed in earlier work under the label of arbitrage asymmetry, the observation that it's relatively cheap to buy underpriced stocks and relatively expensive to short overpriced ones. And I believe this is, if a stock is overpriced, correcting it requires shorting it, locating borrowable shares, paying the borrow rate posting margin. Progress, and I believe this is, and bearing the risk that the overvaluation persists longer than your financing does. This is, as a result, overpriced stocks stay overpriced longer. Progress, and I believe this is, and the short leg of the mispricing portfolios is where a disproportionate share of the total return spread comes from. And I believe this is, the paper connects this to investor sentiment. Progress, and I believe this is, when market-wide sentiment is high, when retail investors are optimistic and overvalued stocks are bid up further. The short leg of the mispricing factor is positioned in stocks that are expensive to correct and likely to stay expensive. Progress, and I believe this is, the return spread gets wider, not because the long side gets cheaper, but because the short side gets more overpriced. Progress, and I believe this is, this asymmetry between the long and short legs is what distinguishes a mispricing story from a risk story. Progress, and I believe this is, you wouldn't expect sentiment to amplify a genuine risk premium this way. Progress, and I believe this is, 3 legitimate objections, and the paper acknowledges versions of at least the first 2. First, data mining risk. Progress, and I believe this is, 11 anomalies drawn from the published literature are 11 anomalies that survived the publication filter and the scrutiny of peer review. And I believe this is, aggregating signals that all survive that selection doesn't eliminate in-sample bias. It may concentrate it. Progress, and I believe this is, McLean and Pontiff writing in the Journal of Finance in 2016. Progress, and I believe this is, documented that anomaly returns systematically decline after the anomaly is published as investors trade against it. Progress, and I believe this is, if the underlying signals decay post-publication, the composite factors will decay too. Progress, and I believe this is. Second, the risk versus mispricing debate is not resolved by the paper. And I believe this is, a risk-based investor could argue MGMT and PERF are compensation for sentiment risk, liquidity risk, or some as yet unspecified bad state risk. Progress, and I believe this is, the sentiment connection that Stambaugh and Yu Yuan use as evidence for mispricing is also consistent with a risk story where sentiment is a proxy for aggregate risk appetite. And I believe this is. Third, the sample period matters. Post-2010, progress, and I believe this is, There is ongoing evidence in the broader literature that cross-sectional anomaly returns have weakened. Progress, and I believe this is possibly due to the proliferation of quantitative strategies trading against them. Progress, and I believe this is whether MGMT and PERF retain their Sharpe ratios out of sample is an empirical question the original paper cannot answer. Progress, and I believe this is for a sophisticated retail investor thinking about factor exposure. And I believe this is the Stambaugh and Yu Yuan framework offers something practically useful. Progress, and I believe this is a rationale for combining anomaly signals rather than chasing each one individually. Progress, and I believe this is a composite signal is more stable than any single anomaly, less prone to the specific idiosyncrasies of any one measure. Progress, and I believe this is, and if the arbitrage asymmetry mechanism is real, potentially more durable because the corrective pressure is systematically slower on the short side. This is for a graduate student or early career researcher. Progress, and I believe this is the paper is part of the foundational architecture of how multi-factor asset pricing is done post-Fama-French, how you go from a zoo of anomalies to a principled factor structure. Progress, and I believe this is. And for anyone thinking about the market more broadly, it raises the harder question. Progress, and I believe this is. If these factors represent persistent mispricing rather than risk, what would it take to eliminate them? Progress, and I believe this is the answer is a lot of capital, a low cost of borrowing. Progress, and I believe this is. And a willingness to be short overpriced stocks for longer than most institutional mandates allow. Progress, and I believe this is. Those constraints are not going away soon. And I believe this is. That's the paper, Stambaugh and Mispricing Factors, Review of Financial Studies, 2017. Progress, and I believe this is. The SRN link is in the description. What would change my mind on this? This is systematic evidence that MGMT and PERF have decayed to near zero Sharpe ratios net of transaction costs in the post-2015 sample. Progress, and I believe this is. Or a clean identification of the bad state that makes these returns compensation for risk rather than mispricing. This is. That evidence doesn't clearly exist yet. The debate is live. Progress, and I believe this is. Next week I'll read another. Not investment advice, just a careful read.